Welcome to Chapter 14 and the acquisition of control rules. On the next slide, let's talk about why there are special rules with respect to when one company takes control of another company. We could have a company that is profitable that wants to acquire a company that has a lot of losses. Now, the loss company could have losses with respect to net and non-capital loss carryovers, and perhaps ABLs, allowable business investment losses. Now, the government wants to prevent a company from acquiring another company just to buy their tax losses. Now, first of all, let's talk about what constitutes acquisition of control. Well, that is when there's been an acquisition of shares that allows the acquirer to elect the majority of the board of directors. Now, acquisition of control could also happen if a company redeems shares as well. On the next slide, let's talk about what happens when there is an acquisition of control. Now, for the acquiree, the target company, in our example, the loss company, they're going to have a deem year end on the day prior to the acquisition of control. So let's say acquisition of control happens on July 1st. There will be a deemed year end on June 30th. Now, the acquiree, the loss company, could establish a new year end, or it could keep their old year end. And what could usually happen is that in this deemed year end, there will likely be a short taxation year. Also, any net capital losses, now remember, net capital losses arise from allowable capital losses when we have an excess of allowable capital losses over taxable capital gains. Those will be lost going forward. Any ABLs will also be lost going forward as well. However, non-capital losses, losses which arose from businesses, they will carry forward, but they can only be used in gains from similar businesses or activities which created the loss. There are a couple other conditions that apply, so check your textbook for those as well. Now, any accrued losses at the deemed year end, for example, if there are non-depreciable properties that have an accrued loss, a write-down will be required. For example, land will be written down to fair market value if there is an accrued loss, and that's going to create a capital loss. There also could be write-downs on depreciable property if the fair market value is less than the undepreciated capital cost. That write-down will be treated as deemed CCA. So that will basically be an additional expense for that deemed year end. For accounts receivable, no reserve will be allowed. However, the company will be able to write off specific accounts that they deem to be uncollectible, and those will be treated as bad debts. And finally, inventories will be written down to the lesser of cost or fair market value. So that's a summary of the rules that take place when there's an acquisition of control for the acquiree. Now, on the next slide, there's also an election that the acquiree could elect to follow, and this is under ITA 111(4)(e). Now, this election would allow for the deemed disposition and the immediate reacquisition on any depreciable or non-depreciable property where there's an accrued gain or potential recapture. Now, why would a company want to do this? Well, this way, with a deemed disposition, it's going to create a capital gain, 50% of that is taxable, or it could create recapture, which could allow the acquiree to use up some of those loss carryovers that may be lost or limited in use going forward. And that will create a higher cost base for that particular asset. Now, what will be the deemed proceeds of disposition if they make this election? Well, it could be a range. It could be anywhere from a minimum of the original adjusted cost base to a maximum of the fair market value of that particular asset. Now, the deemed proceeds of disposition, that will serve as the new adjusted cost base going forward. However, there's a special rule for depreciable assets. If a company makes this election for depreciable assets, for CCA purposes going forward, the amount added to the CCA class will be limited to the original capital cost plus 1/2 of the capital gain. Now let's go on to an example on the next slide here. In your textbook, locate assignment problem 14-2, read through the problem, and we will solve part A. So pause the video here, read the problem, assignment problem 14-2, and we will solve part A. So pause the video and read the question first. Okay, let's look at the question together. Now, is there acquisition of control? Yes. There's an acquisition of control that happens on May 1st, 2018. So what that means is there's a deemed year end on the day before, which is April 30th, 2018. Now, in this question, the company currently has a business loss of $48,000, and that includes the write-downs for inventory and accounts receivable. Now, this question is looking at Part A, wants us to utilize all available elections. So what that means is, first of all, there's going to be a mandatory write-down on the equipment as the fair market value of the equipment of $150,000 is less than the UCC of $190,000. So that's a mandatory write-down. With respect to the elections could be made on the long-term investments because there's an accrued gain, also on the land, and also on the building. Now, the land has an accrued gain, and the building has an accrued gain and also recapture. The question also states to elect to have the deemed disposition for these eligible assets at their fair market values. Now, remember we said the range for the deemed disposition could be from the original cost up to the fair market value. In Part A, they're asking us to use the fair market value as the deemed proceeds of disposition. Now pause the video now and see if you can calculate the net income or loss for tax purposes based on these available elections. So pause the video now before resuming to calculate the net income for tax purposes. Okay, let's go on to the next slide and calculate the net income for tax purposes. And let's look at the results of these elections. Well, let's look at the long-term, let's look at the required equipment write-down first. Remember we said with the equipment, this is mandatory. There's going to be a write-down to fair market value. And so in the CCA class, we have UCC of 190. We subtract the fair market value. We want to bring it down to 150. That difference of 40,000 is going to be deemed CCA. So that's going to basically be a reduction to the business income. The long-term investments, that's going to be deemed to be disposed of at fair market value of $82,000. And so we're going to have a capital gain, 50% is taxable. That's going to result in $17,500 of taxable capital gains. For the land, once again, disposition at fair market value, $305,000 minus the cost of $207,000. 50% of that gain is taxable, which results in $49,000. Now for the building, there will be a gain. Once again, 50% of that $20,000 gain is taxable, which results in a $10,000 taxable capital gain. But for the building as well, there's going to be recapture. The recapture is going to be $105,000. Now the recapture is treated as business income, so that's in the business income column. Now we look at the totals for each of the columns. That's going to result in a net increase to business income of $65,000 and an increase to taxable capital gains of $76,500. Now let's go on to the next slide and let's look at the impact in calculating net income for tax purposes. Now, the business income, after we make the adjustments, will be $17,000. Remember, the original business loss was $48,000. We had the write down on the equipment for an additional $40,000 reduction, and then we had the recapture of $105,000. So the net business income will now be $17,000. On 3B, our taxable capital gains, remember we said that that was a total of $76,500, and that brings us to our net income for tax purposes of $93,500. Now, remember, that is our net income for tax purposes. That's not our taxable income. So at this point, I want you to pause the video and calculate the taxable income. Now, remember, in the question, we were told that the non-capital loss balances, we had an operating loss of $42,000 in 2016 and an operating loss of $123,000 in 2017. So the non-capital loss balance at this point is $165,000, and the net capital loss balance from 2017 is $32,000. So pause the video now and see if you can calculate the taxable income to utilize these loss carryovers. Okay, let's resume the solution and move on to the next slide. And let's calculate taxable income. Now remember, net income for tax purposes was $93,500. Now we want to utilize the losses that will expire, and the loss that will expire will be the net capital loss carryover. Now the net capital loss carryover, we can only use it up to the taxable capital gains. Now remember, the taxable capital gains were $76,500. The net capital loss carryover was less than that, so we can utilize the full $32,000 of the net capital loss carry forward. Now with respect to the non-capital loss carry forward, we can only bring the taxable income down to nil, so the maximum we can use is $61,500, and that's going to bring our taxable income down to zero. Now, our updated loss carryovers, moving over to the next taxation year. Well, remember our net capital loss carryovers, we utilized all of it, and so that's going to be nil. And once again, if we did have any net capital loss carryovers remaining, those would be lost going into the next taxation year. Our non-capital loss carryover was originally $165,000. We used up $61,500. We have left over $103,500. Now, once again, those are limited in use going forward, but we don't lose them. We can carry those forward. Moving on to the next slide, let's figure out what will be the updated adjusted cost base of the assets, and also what would be the cost for CCA purposes, if applicable, on the depreciable assets. So see if you can figure out, moving forward, what are the updated cost bases of the four assets. So pause the video now and then resume the video once you're ready to check your solution. Okay, let's look at the updated cost basis going forward. Now, first of all, for the long-term investments, that's going to be the fair market value, which is $82,000. Remember, that was the deemed proceeds of disposition. For the land, the same thing. The adjusted cost base of the land going forward will be the fair market value of $305,000. Now for the building, for capital gains purposes, it will be $485,000. But for CCA purposes, remember we said for CCA purposes, it's going to be the original cost, which was $465,000 plus 1/2 of the gain. Remember, only 50% of the gain was taxable. So for CCA purposes, we're only able to add $10,000, which will bring the total to $475,000. That's the amount that can be used for CCA purposes. And finally, for the equipment, we use the fair market value of $150,000. So that brings us to the end of part A for this assignment problem 14-2. and also to the end of this tutorial for the acquisition of control rules. Good luck with your studies.